I'll just give a quick wrap of where we've landed for the year in terms of some operational highlights we've achieved. And then John might just step through some financials very quickly. What we saw was continuing growth in our Asian business. That's our third half of double-digit growth there. We always say it's a 6 to 8% growth market, but you got to believe us. 15%. It's not we do every time, but it's been a good 3 halves in a row, which is great. Many of you would have been, in fact, you even helped us with our acquisition of the Zenith business, which was completed last Thursday. That was our biggest acquisition we've done to date. We've done 8 so far. That was our biggest. It was a takeover of a group where had already teamed up with someone else, and we took a stake back in February and got a deal through just recently, which is a good outcome. We haven't got synergy details yet. We've only took the keys to the car back in last Thursday. We'll give some more update on that at the AGM in November. But a good outcome for us, and it's something that we're very proud about. We've always talked about margin. We talked about margin when I've lived and breathed margin all my professional life, and we've improved that in our Spruson and Ferguson business, particularly where we combined the Brisbane offices of Cullens and Fisher Adams Kelly Callanans into Spruson's last July. And we've improved the margin of our New Zealand business of AJ Park. We bought it about 15-16%. That was in November 17. It's now running at 22%, which is good. And the other thing about AJ Park, which we love, which we had to achieve also in the Zenith business, is we get it's not much margin for AJ Park, but it's a margin for our Asian business, in that we get their cases, the patents for their domestic clients in New Zealand. Of course, they're filing into our region in Southeast Asia, and they come through Spruson and Ferguson Asia. So AJ Park's one of the top 5 clients of Spruson and Ferguson Asia, which is a great outcome. And some of the business units under Zenith, including Proof of Fact, which is a big Melbourne firm well known to people here, should be as big. We have this technology business. Those of you who followed our story for a while, we had a technology business called Practice Insight. Had 4 products. I sold the third one off in May this year. For about just under €1 million. We sold 2 others in August last year for about 10 million Australian dollars. So it's left one. It's called WiseTime, which is an autonomous time tracker, which is a good product, and it's in active trial, active subscription now. We like it, but we're hopefully on the pathway to value with that as well. Our success really is, we're a people business, have been all the time, professional services. You have to incentivise people, and one thing we have done this year is we've rolled the incentive plan into the expanded Spruson's offering in Brisbane, which has been a good outcome. And we've done it into AJ Park, and part of my undertaking is to do it into the Zenith group of businesses as well, which don't have any. So that comes at a cost, of course. So any synergies we get in the first year in Zenith will have to be offset by that incentive plan. But even with the incentive plan in AJ Park, we still outperformed expectations, so that was great. So I've already indicated increased referrals from the AJ Park and Spruson's business into the Asian business, but we want more of that going forward with Zenith, and we look forward to that.
Probably our headline numbers, the largest impact on those has been the foreign currency tailwind in the current year. So the comparative numbers came through at 77.5 US cents. This year's numbers came through at 71.5. So that's 6 cent tailwind, really a benefit to us. And looking forward, so everyone can see the exchange rate at this time. So of a newly expanded group, remembering that 50 or 60% of our revenue comes through in US dollars, 1 cent in the newly expanded group, including Zenith, 1 cent should mean a $1.8 million improvement at the top line, most of which will fall through to bottom line. Investment highlights, I guess, for the year, 25 cents per share, 13 cent final dividend, 60% frank, which is up 11 cents. Doing a quick tour around the grounds in the Australian and New Zealand business. Although the filings were down in Australia, cyclically, nothing particularly of concern there, no major client losses. However, the patent business in Australia did meet its budget and achieved its targets, so that was a great result. Where you did see a revenue decline was in our trademarks business. So the trademark overall market was down and our business followed that trend down. And also in our legal business. The legal business tends to rise and fall on the number of cases it's got going on. In the prior year, it had a number of cases going on, and in this year, it didn't have as much. So that's what caused the revenue decline in that business. However, pleasingly, despite that, we did have EBITDA growth in Australia. That was due to the Spruson and Ferguson merger, particularly the brands in Brisbane where we consolidated offices. And as Andrew referenced, the great margin expansion in our New Zealand business from 16 to 22. Asia was the real standout. Again, double-digit growth in that region, third consecutive half. We did have the benefit that we called out in the last quarter. A particularly significant file gave us an unprecedented level of cases. And really that supports our great Asian network, that we had the network built, that this particular file was able to come and utilise the IPH. That was really pleasing. As Andrew also pulled out for next year, looking forward, we've seen the success of AJ Park in New Zealand sending its clients' cases to our Asian network. We really think that's going to be a benefit of the XIP business, taking its domestic clients here in Australia. They're filing into Asia at the moment, but not filing with us because previously we were their competitors. Next year, we hope to bring that. So I guess looking forward, a big question people keep asking us is about these Zenith synergies. A little bit early for that, given that we only kind of took ownership last week. Looking at it, I think we see three buckets potentially of synergies. We've got the corporate costs, which you would hope would come through relatively quickly in this first year. As Andrew referenced, the CEO is already no longer with us. Probably guiding in that first year to be tempered a little bit because we are implementing the incentive plan to that business, which we think is very important to lead to alignment. So that we're guiding a little bit conservative first year. The other buckets of costs, obviously, we can look at the structure of these particular businesses, hopefully to raise their margins to more Spruson and Ferguson or IPH type margins. Probably the structure of those businesses is a little bit different, so perhaps not to get to the same level, but we certainly think there's improvement in all of those businesses. And thirdly, the cost or not cost, the revenues of taking those clients into Asia. So that won't be reflected in our Australian business, but again, a support for the Asian business's growth